Okay, we're going to take a look at Chapter 19, which deals with variable costing versus absorption costing, which is a couple terms that we haven't really used too much before, although we have talked about what variable costs are. Now, this has to do with, this is a unique chapter in that it'll be difficult, I think, I've been trying to think of how to make a video to explain it. I think it's going to be somewhat tough to grasp, so that's why the exam is not going to have very much of this chapter on it. It's going to be basically the next exam that we have will be on chapters 18 and 19. About 95% of it will be chapter 18, and then about 5% basically just definitional questions on chapter 19 here. But we've got to do the best we can. So I'm going to try to go through this and explain what this is. We're talking about variable costing versus absorption costing. And it has to do with product versus period costs. And so I'm going to zip forward in the chapter here just to the first page of the real information. Now, variable costing deals with what we're going to do in variable costing is that we are going to include in the cost of items we produce only the variable costs, which are direct materials, direct labor, and variable factory overhead. Variable overhead. Now recall, if we have some overhead like rent's going to be fixed, some is going to be variable, and if I have a mixed cost, I'll use a method like the high-low method to break out the variable versus fixed portions so I can deal with them separately. And in variable costing, only the variable costs become part of the cost of the product. In absorption costing, which is what we've been looking at, the cost of the product includes the direct materials, the direct labor, and both variable and fixed overhead costs. So let me show that to you just graphically here. We've talked about keeping track of the costs of a manufacturing concern. We've got our raw materials, our work in process, finished goods, cost of goods sold, and then over here we've got a lot of period costs. Remember these period costs, selling and administrative expenses that get expensed regardless if we sell anything or not. So we said that all the costs are accumulated in the work in process, direct materials, direct labor, and factory overhead, all factory overhead. So we're including all costs in work in process. And those costs then get transferred to finished goods, and that's where they sit until we're going to sell them. And then when we sell them, we're going to transfer it to cost of goods sold. So these costs will end up, all of these product costs will end up in cost of goods sold. So the rent on the factory rent, well, it attaches to the product and gets expensed as cost of goods sold. All of those costs attached to the product. And then, of course, the selling and administrative expenses, we expense those in the period. We don't let the sale of the products determine when we're going to expense it. They get expensed in the period that they are incurred. So, when am I going to expense the factory's rent expense? Well, it depends on when the products that I produced that month that have absorbed some of the rent of the factory. They could be sitting on the shelf for a long time, and then when they get sold, that's when they're going to get expensed as cost of goods sold. How about the rent on the showroom? When does it get expensed? It gets expensed in the month that we incur it. So the January rent gets expensed in January, and the February rent gets expensed in February. It's a period cost. We expense them in the period, not in the period incurred. In product costs, we attach the cost to the product and then follow it through to cost of goods sold. So the three different costs in a factory are the direct materials, the direct labor, and the factory overhead. But we can even break this up a little bit. We can say that factory overhead can be variable and fixed. Now, not so with direct materials. Direct materials is always variable. Direct labor is always variable. But factory overhead can be a portion variable and a portion fixed. Now, in what we've learned so far, that all of these, every one of these, will go to the work in process account and end up in cost of goods sold. But this is what's called absorption costing. And that's everything, that's all we've learned so far. And this is required for generally accepted accounting principles for financial reporting. We have to include all the costs of the factory, whether variable or fixed, in the costs of the product and trace it through along with the timing of the sale of the product to cost of goods sold. And that's when it will be expensed, when the products are sold. But under variable costing, we're going to treat one of these items differently. The one item that we're going to treat differently under variable costing is this, the fixed factory overhead. The proponents of this method say that feel that because this fixed factory overhead, like the factory overhead rent, it's really, it's locked in. It's not going to change based on production levels, where if I double my production for direct materials, my direct material costs will double, as will my direct labor costs, as will my variable overhead, because those are all variable. They increase with production levels. But factory overhead, fixed factory overhead, doesn't increase with activity levels. It's fixed. So the proponents of this method say, we think that only the variable costs should go to should be assigned to the product. Variable costing, and the fixed overhead should be expensed in the period incurred. Under this method, we're going to treat fixed factory overhead as a period cost. And that's the only difference between these two methods. And we're going to see why it's important that we distinguish between the two. But it's just this one cost of the factory, fixed factory overhead, we're going to expense in the period incurred. We're not going to attach it to the inventory and transfer it out. Now, why is this important? What is the major implication of this? Well, this is the implication. If I have a factory, of course, I have a factory, and under absorption costing, which we've learned already, that if I produce a certain number of items, and they all take direct materials, direct labor, variable overhead, and factory overhead, I'm going to produce 100% production, maybe I'm going to produce 10,000 units. Now, if I sell 7,500 of them, so I'm just going to put 10,000 here, and if I sell 7,500 of those units and keep 2,500 in inventory, which means that the cost, all of these costs, the costs of 10,000 units went to finished goods, but the cost of only 7,500 went to cost of goods sold this period. The other 2,500, the cost of those 2,500 are sitting in finished goods, and they'll be expensed whenever I sell those. So in this case, when I sell 75% of everything I produced under absorption costing, I will be expensing 75% of my direct materials, direct labor, variable factory overhead, and fixed factory overhead. 75% of them will be expensed as cost of goods sold. 25% of these costs will be hung up in inventory. They'll be kept in inventory, including the fixed factory overhead. But now under variable costing, same scenario, we're going to expense the fixed factory overhead. It's going to go over and get 100% expensed in the current period. We're not attaching it to inventory. So what ultimately is going to happen is that even though I sell 75% of what I produced, and therefore I'm going to expense 75% of the materials, labor, and variable overhead, I'm going to expense 100% of the fixed factory overhead. We're not going to use any of this fixed factory overhead. It's not going to be attached to the inventory and get hung up in inventory. It's going to be expensed in the period incurred, and that's what the whole purpose of this is to measure this differently. Now let's go back to the book. Let's go back to the text. And so again, they're saying that variable costing is the way we're going to determine the cost of the products we produce. Under variable costing, we're only going to include direct materials, direct labor, and variable overhead. That's it, all variable costs. Under absorption costing, we're going to include those three as well as a portion of the fixed factory overhead. And a diagram here that they used for this is that we have the absorption costing, which product costs include a portion of all of these, all the costs. But under variable costing, the one difference is right here. Fixed overhead will be treated as a period cost. It is not treated as a product cost. The only difference between these two methods is how I'm going to treat fixed overhead. Fixed overhead. Now they go through an example in here, but I wanted to go through an example with you showing that how this is, why that this is important. So we're going to build an example of our own. Okay, let me go back to a piece of paper here. Now here's why that variable costing is important, even though it's not allowed for financial reporting. We have to use absorption costing for financial reporting. But internally, managers like variable costing for this reason. Okay, suppose we've got a product. Let me see here, I'm going to do this. Suppose that we've got a product that we're selling. The sale price of this product, we sell them for $100 a piece. Now, the cost to produce them, the direct materials are $12 per unit. The direct labor is $20 per unit, and the factory overhead variable, the variable overhead, is $14 per unit. So if I make one more unit, it's going to cost me these three added together. Okay. Now also my factory overhead fixed. The fixed factory overhead is $160,000 per period. Okay. Now these are my product costs, obviously. My product costs. Okay, now in addition to this, I've got selling, now these are, I'm going to just put here product costs, prod. Now in addition to this, I also have period costs, which are the selling and administrative expenses. And the selling and administrative expenses can be broken down to variable, like commissions. Whenever a product is sold, I have to pay a commission to somebody. That's $4. And maybe the fixed selling and administrative expenses, like the rent on the showroom, is $100,000. It's $100,000. Okay, so these are my costs. When I produce a product, well, if I don't do anything at all, I'm going to have $160,000 fixed costs at the factory I got to pay, and $100,000 fixed selling and administrative expenses I have to pay. But I have variable expenses as well. Now, when I produce products, I'm going to incur materials, labor, and variable overhead. And when I sell them, I'm going to incur $4 of selling expenses as well. So what I want to know is what is my before we even get into this, let's say this. First, What's my contribution margin? This is kind of a review of the last chapter, chapter 18. My contribution margin. Well, my contribution margin is per unit is my sale price less the variable costs. So I'm going to put contribution margin equals sale price minus the variable costs. My sale price is $100, so when I sell a product for $100, the variable cost of that was 12 plus 20 plus 14 plus $4. All the variable costs, not just the product cost, but all the variable costs. And the variable costs here are $50. So my contribution margin is $50. $100 minus the $50 in variable costs, $50. So how many units do I need to sell just to break even? Break even point. We take our fixed costs, which are total fixed costs of my company are $260,000, divided by the contribution margin per unit of $50. How many units do I need to sell making $50 a piece so that I have enough of these just to cover my fixed costs? Comes out to, looks like 5,200 units. $5,200 units. Which is how much in 5,200 units, so that's a break-even point in units. What's the break-even point in sales? Well, remember, it's the fixed cost divided by the contribution margin ratio. And the ratio, what's the ratio here? I'm keeping $50 of every $100. That's 50%. So 260 divided by 50% is $520,000 in sales, which is 5,200 units at $100 a piece. It's the same point, so that's my break-even point. 5,200 units, which is $520,000 in sales. So now let's do this. What we're going to do is we need to sell 5,200 just to break even. Now, what we're going to do is we're going to make we can sell 8,000. We can sell 8,000 of them. So how many should we make? Well, let's make 8,000 of them. So I'm going to put make, produce, so we can sell 8,000 units. And obviously we're going to be making money because we're a couple thousand units above the break-even point, so we're going to be making money. Let's see how much money we make here. So if I make and sell 8,000 units, what will my sales be? Well, 8,000 units at $100 a piece will be $800,000. What will my cost of goods sold be? Cost of goods sold. That is how much will those $8 cost me, or these 8,000 units cost me? And we're doing this under absorption costing. We're doing this under absorption. So if we make 8,000 units, we're going to, the cost of those units is $12 for materials, $20 for labor, $14 for variable overhead. And then we need to divide this by 8,000 to find out how much this is per unit. And that's $20 per unit. So the total cost per unit here is 12, 20, 14, and 20. It's $66. So the cost of goods sold, the cost of those 8,000 units at $66 a piece. Take a minute and pause this if you have to, just so you understand the $66. It's the materials, the labor, the variable overhead, and the fixed factory overhead spread over the number of units I produce. That's part of the cost under absorption costing of the units I produce. So cost of goods sold at $66 a piece is $528,000. So my gross profit here is $272,000. And now I have my selling and administrative expenses. The variable selling and administrative expenses, well, they are $4 per unit. I sold 8,000 units, so that's $32,000. And the fixed is $100,000. So 272 minus the 132. Looks like net income here is $140,000. That's if I make 8,000 and I sell 8,000. Okay. So, where's this at? Remember this variable, the variable selling administrative, this was at $4 a piece. So that's where these numbers are coming from. Now, here's where the problem, this is where they found the problem to be, is that we may have a manager that is maybe he was told that he has to have a minimum net income of $150,000. If net income is not at least $150,000, he's out of here. Well, you know, obviously he's going to look at this and say, wow, I didn't make it. I didn't make that $150,000. Or I only made $140,000. That's all the net income was $140,000, and we can't sell any more units. That we found that we can only sell 8,000 units, and so we made 8,000 units and we sold them. Is there anything I can do? Well, would it surprise you to know that, based on absorption costing, that he can manipulate this number by not changing the sales level at all, but changing the production level. It doesn't seem like he should, because he sold 8,000. These are the costs. These are the costs of the factory. Selling 8,000 units generated $140,000 in net income. But how about if he did this? If he said, no, let's not make 8,000 and sell 8,000. Let's make 10,000 and sell 8,000. Again, we're selling the same number. We're just going to make 2,000 more and let them sit on the shelf. Will that have any effect on net income? Well, let's find out. Sales will be 800,000. No difference there. You're selling 8,000 of them at $100 a piece. But notice what this does. When we make 10,000, we're going to spread the fixed costs over 10,000 units. That means that each unit will have $16 of fixed overhead, which means that this cost is going to do what? It's going to go down to $62, I believe. Yes, $62. 12 plus 20 plus 14 plus 16 is only 62. So cost of goods sold, now, same method, just making more units. Cost of goods sold at $62 per unit is for, let's see, 8, 1, 2, 3, because you sold 8,000 and they cost 62 a piece, $496. So gross profit is $304, and selling and administrative expenses are the same. It's going to be $32,000 for the variable costs of selling those 8,000 and $100,000 to get to net income of, and it comes out to be $172,000. Wow, that just by making 2,000 more units, I was able to increase my net income by $32,000. How did that happen? And it doesn't seem like that a manager should be able to manipulate the bottom line net income by not changing sales at all, but just changing production levels. Why did this go up $32,000? That's the question. Anybody looking at this would say, well, if the sales are the same and I left the sale price the same and all my costs are the same, why did changing production levels cause the net income to go up? Well, here's why. When we made and sold 8,000 units, we made them all and we sold them all. This 160,000, all 160,000 went over to cost of goods sold. There was nothing left in inventory. We just threw everything here and we sold everything we made. All 160,000 is in cost of goods sold. But here, when we're making 10,000 and only selling 8,000, there are still 2,000 units in ending inventory. 2,000 units are getting stuck right there. And how much fixed factory overhead is in those units? Well, under this method, it's by making 10,000, they came out to $16 a piece. That means that there is $32,000 of fixed factory overhead that didn't get expensed by making 2,000 more. That fixed factory overhead attached to units that are landing right here and staying there, not making it to cost of goods sold. So that's why under absorption costing, and I totally agree, I think fixed factory overhead is a product cost and it should be included as part of cost of goods sold. But I also agree that internal managers need to be aware of this phenomenon. And so they may want to internally rerun these costs using variable costing. Variable costing. How would the numbers change if I was measuring both of these? If we were going to make and sell 8,000, we're going to make and sell 8,000. Whoa, I didn't mean to do that. And then we're going to see what it would look like if I make 10,000 and sell 8,000 under variable costing. Now, variable costing sets it up differently. Variable costing does it in the contribution margin approach, where we don't say sales, cost of goods sold, and selling and administrative. We say sales less variable costs will give us contribution margin, and then we subtract off the fixed cost to get to net income. What would it be? Well, the sales would be the same. We're going to make 8,000 and we're going to sell 8,000, and we're going to sell them for $100 a piece here. So it'd still be 800,000. What's the variable cost of making those 8,000 units? Well, the variable cost of making and selling 8,000 units. Well, the variable costs were these 12 plus 20 plus 14 plus 4. That was $50, right? So the variable costs let me do a different color, at $50 a piece would be 400,000. So my contribution margin would be 400,000, right? And then the fixed costs are 160 and 100. 260. Notice that we're treating the fixed factory overhead, we're expensing it all. So net income is then $140,000. Now let's do it. What would happen if I made 10,000 and sold 8,000? Well, it's 8,000 that were sold would still have sales of 800,000. The variable costs are the same. So the contribution margin's the same. We're still going to expense all the fixed cost, so our net income is the same. Notice that there is no manipulation possible. No manipulation. So we don't have production managers increasing or decreasing production just to change the bottom line, to change the net income, to increase it or decrease it or something like that. So the problem that we have here is this. We have to use absorption costing for financial statement reporting purposes, but that can cause manipulation, but we don't want production managers to be able to manipulate it, so we will base their bonuses and their reviews and their performance on the internally generated variable costing, because there's no way to manipulate that. So we will base their, how good they are, or their evaluation will be based on variable costing, but we'll still use absorption costing for financial statement reporting purposes. So that removes any influence or any temptation by managers to do this, because they know they're not going to get away with it. So that's the difference between these two methods, is simply how we're going to treat this, that fixed factory overhead. How we're going to treat that is the only difference. Now the text goes through another example here, which I'll let you do on your own. It'll take you some time, but just go through where they've talked about the direct material cost per unit, direct labor, the variable overhead, and they gave it to us in total, but notice they did compute it to be $3 per unit, and then the fixed overhead and expected units produced, so they calculated out a cost per unit using both absorption costing, which includes fixed overhead. Notice that the material costs, the labor costs, and the variable overhead costs are the same. It's just that under absorption costing, we're going to spread the fixed overhead, $600,000, over the number of units that we plan to produce. In this case, it was 6,000, so that's $10 a piece. So under absorption costing, the total product cost is $25. Under variable costing, it's only $15. We're not going to include the fixed factory overhead as part of the cost. And it goes on to read, then it goes through the same kind of computations that I just did over several years here, where when the units produced equal the units sold, well, you're not leaving anything in inventory. Everything you're producing is getting expensed, so there'll be no difference between the net incomes. No difference between the net incomes, because the production levels are the same. You're selling everything you're producing, not getting anything hung up in ending inventory. But when production levels are different, when the units produced exceed the units sold, that means that you are hanging up fixed factory overhead under absorption costing and attaching that fixed factory overhead, to inventory. When production levels exceed what you sold, that means that you're going to leave, you're stocking the shelves, and that includes some fixed factory overhead that will not get expensed. So when production levels are higher than units sold, your net income under absorption costing will be higher, because you're not expensing everything you're producing. And the opposite is true when the units produced are less than that are sold. That means that when you produce less units than you actually sell, well, then you're selling everything you produced this period plus some that you had last period. So you're expensing this period fixed factory overhead of a prior period that got hung up in fixed in inventory. I know this is very confusing, and this chapter it's difficult to do it face-to-face in class, so it's even more difficult in this setting. But I just want you to get the basic concepts down. Just what is the one cost that's treated differently? They summarize the reporting here. Go through the numbers. Watch the little videos here. There's an easy way to convert variable costing to absorption costing. You can calculate net income under absorption costing, which is what I did here. Let's see, where's my summary at? Well, you can compute income under absorption costing quickly if you know the income under variable costing, which just includes net income computed with no fixed factory overhead going to the product. You start with your net income and add to that net income any fixed overhead that's in ending inventory. Any fixed overhead that's in ending inventory, because under absorption costing, that's not getting expensed. So that's going to increase your variable costing net income. But then likewise, if there's any fixed overhead in beginning inventory, subtract it off because it's getting expensed this time. So income under variable costing, add the fixed factory overhead that would get caught in inventory at the end of the period under absorption costing, and subtract off the whatever got caught in inventory at the end of last period. And that will convert your variable costing net income to absorption costing net income. Yeah, this is getting in depth here. Just read this. Don't get too deep into it. Don't get your head spinning too much. Just get the general basics, just the basics. Okay, let's see, where are the homework problems? I think I'm going to cut this video right here. It's just a summary of the concepts of the chapter. And then I'm going to load another video which is actually doing the homework problems for you. Of course, the solutions are already at Canvas, but we'll walk through them together in the next video.